Hello and welcome everyone to this session on risk management. This is a slightly long topic, therefore we are going to divide it. We are going to divide it into two parts. The discussion of it, that is. In the first part, we are going to introduce ourselves to the notions of, let's say, what is the reward, what's risk, what's exposure, how we can hedge as a company against exposure, and then we will look at the role of, we will introduce ourselves to some basic derivative fundamentals and look at what are forward contracts, what are futures contracts, and learn to compute their payoffs and the situations where those contracts can be used for hedging purposes. In the second part of this discussion, we are going to focus entirely on interest rate swaps. So that's going to be a different discussion altogether. So let's get started quickly by, first of all, introducing ourselves to some basic terminology. So I'm writing a couple of words here on which we need to focus at the outset. The first, let me get my pen in order. Right, so the first word that I'm giving you to think about is reward. The other one that I want you to think about is risk. And the third one is exposure, right? And once we have accounted for these three, then we will bring in hedging. Right, so let me give you an example situation. Let me throw three sentences at you. Sentence one is sentence one. Let me write it here. Sentence one is that if you take a night walk, a late night walk, on a moonlit night. Well, I'm creating a little bit of a romantic scene for all of you there. So a late night walk on a moonlit night. The moon is shining brightly. It's a cloudless sky. Stars are there. The moon is there, and the breeze is cool. And that can entice you to go outside and take a walk, take a stroll. So a late night walk on a moonlit night is beautiful, or can be beautiful, depending on your own personality type, that is. That's the first sentence. The second sentence that I want you to think about is that if you go out for a walk like this late in the night, then that increases the chances, or that increases the probability or a chance of you getting robbed. So chances of getting robbed increase because of this action of yours. And the third sentence that I'm giving you to ponder on is that you decide to take one such walk. You take one such walk. Now, if you were to match these three sentences with these three items here, let me call this one A, this one B, and this one C, then which sentence would you associate with which word that you see on the left-hand side? Obviously, the pleasure or the beautiful experience that you can derive out of a late night walk on a moonlit night is the reward. So if we were matching the sentences, we would say that this sentence can map into some kind of a reward, intrinsic satisfaction, or the pleasure derived out of that walk. But in doing so, you are exposing yourself to the possibility, you are increasing your vulnerability towards getting robbed. So basically, the exposure is that you take one such walk. So this is your exposure, right? So you're increasing your vulnerability towards getting robbed by deciding to take one such walk. And the fact that there may be a chance of you getting robbed, something unpleasant might happen because of this, that is the risk. So this maps to item B here. Well, of course, you can hedge your risk. You can hedge your risk. How you can do that by let's change back to color red and say you can hedge the risk, or you can hedge your exposure against this possibility of getting robbed by taking along take along a strong friend with you for protection, right? So that's hedging. Hedging basically means, so if you were to think about hedging, it would simply mean that you are thinking about immunizing yourself, immunizing yourself against a certain risk or exposure. You could also say simply that hedging means or can be interpreted as some kind of a protection that you create, or some kind of a barrier between yourself and a risky situation. So these are the three words that I wanted to start with when we start thinking about risk management. And I should have said it at the top that while we're talking about risk management here, this is not from the perspective of an individual investor. This is more from the perspective of a company or an enterprise or an institution. So whereas you would believe that as an individual investor, maybe you would, if you were asked to manage your risk, you would go with the age-old proverb of not putting all your eggs in one basket, and diversification would be the key word there. That would be the mantra. So spread out your investments over a number of dissimilar assets. That is what the diversification principle is, and that's perfectly applicable to an individual investor. But if you start thinking in terms of a company, hedging might be a better idea, which, as you will learn in a little while, means taking an offsetting position in similar assets or similar variables. So the talk is no longer about going for dissimilar assets or uncorrelated assets. We are basically going to be focusing on similar assets, but the difference is going to be that we are going to take different stances, offsetting stances in the same asset. For example, buying something and selling the same thing are two opposing stances. So, but that something remains still the same. So that's a preliminary idea about what hedging could be, and we will develop more understanding about it as we proceed further in the topic. So let me ask you a question here. Can I say that out of the discussion thus far, can I say that risk does not arise unless you are exposed to a risk factor? So if you heard the sentence correctly, you would realize that what I just said was true, actually. What I said was that risk will not arise unless you are exposed to a risk factor, right? So let's just formalize our understanding about these three terms here. So when we say reward, let me write this in a different color now, because we are transporting our understanding, basic understanding about reward, risk, and exposure into a corporate sense now. So let's say that reward for us means a compensation, compensation. Pretty bad handwriting, so I'm going to erase that and rewrite this for you. Let me pick up the pen. So a compensation then, compensation for something. Well, for what? For taking risk, right? Right. And then what is exposure? Exposure, ladies and gentlemen, is vulnerability, as I said earlier. vulnerability, vulnerability to a risk factor. And well, what's risk then? Risk, as you know from before, maybe from your prerequisite courses also, is simply the probability or the probability of loss, right? And in this case, probability of some kind of a financial loss. So let's just scroll down and make some more space to carry on. Right. So we also spoke a little bit about hedging, and I said that hedging would mean taking an offsetting position in the same or a related asset or variable. Let's just formalize this here. Let's just note it down formally here. And as we proceed, and when we take more examples, you will begin to see the meaning of this term. Hedging, for now, just remember, is where you take an offsetting position. Offsetting, to offset something is to cancel the effect of something else. So take an offsetting position in the same asset, or variable. Is it different from diversification? Well, of course, yes, because as we said earlier, diversification would mean taking positions in unrelated assets or variables, whereas in hedging, we are talking about the same asset. So now let's take an example here. Let's take an example of what we can understand to be a natural hedge in a business situation. Let's construct something from the top of the head. I'm going to give it a heading here. We're going to talk about a natural hedge, something that arises naturally during the normal day-to-day functioning of a business. So let's call it a natural hedge. To do this, let's write down a fact first. And the fact is that if you think about foreign exchange rates, and this was your last topic as well that you read about. So if you think about exchange rates for a moment, you would realize that exchange rates are volatile. They keep fluctuating from time to time. Right, and so higher the volatility, the greater would be the risk, because there are going to be more the more the ups and downs in a particular variable, like exchange rate is a variable. So the more ups and downs it goes through, the more risk it poses to somebody or to some entity which is exposed to this fluctuation, right? So given the fact that exchange rates are volatile, I'm saying that your business, you have a business with local customers. Your business is with local customers. So you might be tempted to think that you are not exposed to the exchange rate fluctuations because of this. But then let's add something more to the recipe here. So your business is with local customers. Your customers are local, but your suppliers or vendors, you rely on materials from abroad, actually. So your suppliers then are foreign. So foreign suppliers. Now you are exposed to the fluctuations in the foreign exchange market. So you're exposed to the volatility of exchange rates, if any. So foreign suppliers then, right? So let's just complete it. Let's write your vendors are foreign suppliers, right? Let's make some more space. Now let's say these suppliers, let's talk about them for a moment. These suppliers, let us say, give you let's make up something, a 30-day credit. So when they supply you something, they allow you a 30-day credit for you to settle the bill. So for these 30 days, you would have an accounts payable. This will lead to an accounts payable in your balance sheet, which will remain alive for that 30-day period before you settle it. And this account payable is denominated in foreign currency. So I'm just writing F for foreign and C for currency here. So this creates an exposure to the this creates an exposure for you to the foreign currency fluctuations, because you will have to spend your home currency to buy the foreign currency to settle the liability. And if during this 30-day period, the 30-day credit period, if the foreign currency were to appreciate, if it goes up in value, then you can imagine what's going to happen. Then By the time you are ready to settle your bill and the foreign currency has gone up in value, then you will have to dish out more units of your home currency to buy the requisite units of foreign currency to settle your bill. Isn't that so? Because if the foreign currency goes up in value, whatever you could buy with, let's say, 5 units of your currency earlier, now you might need to spend 7 units to buy the same thing again. So that is the risk you have. So in this case, the risk is, let's just make a note of it, because you have an accounts payable denominated in foreign currency. uh, the risk that you're being exposed to is that exposure, let's just make a note here. Exposure is in terms of appreciation in the foreign currency, or in terms of appreciation of the foreign currency, because that will increase your bill in terms of your home currency. You will have to spend more home currency to buy the foreign currency for the settlement of the bill. Now, given this situation, well, let me add a page here so that we can discuss further. So this is the situation. Now, what you can do is, let's suppose, if you want to remedy this situation naturally in the natural course of your business, what you can think of doing is that you can think of expanding your market at the moment you have local customers only. A natural hedge would arise if you expanded your market to include some foreign customers also, and preferably in a country where your suppliers are. So if you have some customers, let's say in country X, and your suppliers are also from country X, then a natural hedge would arise. Because what is the situation that we have created for ourselves here? We have said that if the foreign currency appreciates, you are going to lose out because you have a foreign bill to settle and you will need more units of your home currency to settle that bill. But if you had foreign customers also from the same country, then because of those foreign customers, you would have created for yourselves some foreign denominated accounts receivables also. So the accounts receivables also in the same currency would mean that when it is time for your customers to settle your bill, then you would get more units of home currency in return for whatever they pay you in terms of in terms of the foreign currency. So what we are saying is that with an appreciation of the foreign currency, some of your loss on the payment side due to currency appreciation, foreign currency appreciation that is, some of the loss would be then recovered from the gain on the receivable side. So which means we are saying that an accounts receivable and an accounts payable in the same currency then are offsetting positions on the same asset. What is the asset here? The currency, in this case, the foreign currency being the asset. So we can make a note here. What we have looked at is a natural hedge. The business itself is creating a hedge of its own. An accounts receivable and an accounts payable in the same currency, they cancel out each other's effects to some degree. So an accounts receivable and accounts payable in the same currency then are offsetting positions, let's say, offsetting positions, because they cancel out each other's effects. Offsetting positions on the same asset. And what is the asset here? The asset is the currency, right? So let's just record that fact here as well. The asset is the currency that you receive and pay. Right. So we have seen what a natural hedge could be. So if you need to define it in a bookish way, you could just say that a natural hedge is the reduction in risk that can arise from an institution's normal operating procedures. And when this is not possible, when a hedge like this is not possible naturally, then we will have to take the help of derivative instruments. So let me change color now, because the nature of discussion will change a little bit. So if a natural hedge doesn't arise out of the normal business operations, then to create an artificial hedge, we might need to take help of derivatives or derivative instruments. What's wrong with me today? I'm spelling everything so poorly. So let's just erase this, take our time, and write this down properly. Derivative, and it's difficult to write on the screen sometimes, derivative instruments. So, well, derivatives are financial instruments, just like you are aware of other financial instruments like stocks and bonds. Derivatives are also financial instruments, but they are a little bit different from what you have seen earlier. How? Derivative instruments are financial instruments which represent a claim to another financial asset. Let's just understand this clearly. Derivative instruments are financial instruments which represent, so let's take it slow, represent, claim to another financial asset. Right? As we go along and take more examples, you will learn about that, what we mean. So basically, or why not I give you a general example right now, and then we can formalize it as we proceed. So if you ever think about, we were talking about a moonlit night at the top of this session. So think about the moon for a moment there. If I ask you a question, does moon have natural light? Your obvious answer is going to be that no, moon doesn't have natural light. And likewise, all planets in the solar system and their satellites also don't have their natural light. They simply reflect the light that they receive from the sun. Isn't that so? So basically, moonlight is a derivative of the sunlight. On its own, it's dark, but it derives light. The moonlight that we see, it is simply a derived version of the sunlight. So a derivative instrument works much in the same fashion. On its own, on and off its own, it doesn't have any value. There must be some underlying asset. So when we say here, there must be another financial asset here. This is known as an underlying asset. Underlying asset. There must be some underlying asset or some underlying variable which assigns some value to the derivative instrument. If this asset or this variable is not there, if it's not there, then the derivative instrument collapses and it has no value of its own. It simply becomes a worthless piece of paper. So remember, for a derivative instrument to have some value, there must be some underlying asset on which it is based. You can think of some examples like forward contracts, like futures contracts, like options contracts, like interest rate swaps or currency swaps. These are all examples of derivative instruments. Let me talk about a forward contract for a moment here, and the reason why I'm picking this one up is because I believe you would have recently read about a forward transaction or a forward contract in your last topic, which dealt with international finance. So, what was a forward rate or a what was a forward transaction in the previous unit? You would remember that a forward transaction would be one where you would pre-specify an exchange rate. So we are talking about a forward transaction in the foreign exchange market at the moment. So you would pre-specify an exchange rate, and though the actual exchange of currencies would happen at a later date, the exchange rate would have been pre-specified, and that exchange rate would be applicable to the exchange of currencies at a later date. So which essentially means that you would lock in an exchange rate for a given transaction that is supposed to take place at a future point in time. So let's say that exchange rate is TT dollars to US dollars. But ladies and gentlemen, do realize the fact that if there are no TT dollars in the world, or if there were no US dollars in the world, then a forward transaction or a forward contract like this, which specified that at the end of 30 days from now, I am going to exchange 500 US dollars with you for TT dollars at an agreed upon exchange rate of 6 TT dollars to a US dollar. It doesn't mean anything since there's nothing like a TT dollar or a US dollar in the world. So for a forward contract to exist, the existence of TT dollars and its counterpart currency, the US dollars in this case, is essential. Unless these two assets, TT dollars and the US dollars, exist, there can be no derivative instrument or there can be no forward contract based on this currency pair, that is. So an existence of an underlying asset is a prerequisite for a derivative instrument to emerge out of it. Right. So since we are still preparing ourselves to go further into the topic, let me inform you about the various positions we can take in derivative instruments. Let's focus on positions here. When I say positions, you can understand this as a stance that you want to take, right? So why I'm using the word position is because earlier we said that hedging would require us to take offsetting positions. You could also have said that it would require us to assume offsetting stances. So let's just prepare a little scheme here. I'm saying here on this side of the sheet that I have an asset. I have an asset. And just below this, somewhere here, I can write I don't have an asset. I don't have an asset. On the other side, right-hand side of the sheet, I'm going to write here I intend to buy an asset. And here, let me write I intend to sell an asset, right? So these are the four scenarios that we are going to focus on. So let's pick up the first one. I have an asset. If this is your position, we are going to give a name to this position. We are going to say that if you have an asset, then you are, let's change color. You are naturally long. This is a natural long position. Remember this. If you don't have an asset, let's change color. If you don't have an asset, this is a naturally short position. You're short of something, naturally short, right? Let's go to the right-hand side where we have said, I intend to buy an asset. I intend to buy an asset means that you intend to go long. So we are going to write this as going long. And when you say I intend to sell an asset, then you can write this as that you intend to go short, so going short. Right? So basically a long position and a short position. Long position is always associated with, let's just make it simpler. Long position is always associated with something incoming. Incoming, what does that mean? Either you have the thing, or you're going to buy it, or you're going to receive it from somewhere. Maybe somebody is going to give you a gift, or maybe a farmer is going to harvest a crop and that is incoming, which he will need to sell later on. And at that time, the farmer's position will become short when he is wanting to sell that, right? And a short position then is the opposite. Short position is outgoing, where you are generally selling off something or giving something away. Right? So now let's bring in the notion of hedging. So let's think about the possibility. Let's think about a situation when you are naturally long. What does that mean? It means that you don't have that you have an asset. So just think about the scenario. You have an asset, you paid some money to get it. Now, having an asset, well, you feel happy about it, that you are enjoying ownership rights on it. But at the same time, at the back of your mind, you're a little bit worried. You don't want that asset to lose its value over time. So you want to protect its value. Let's think about a share of stock. Maybe you purchased a share of stock, and then a rational investor like you would always want the share price to not fall below your purchase price at least. Otherwise, you will be incurring a loss, isn't that so? So you have an asset. In this case, let's assume it to be a share of stock. So you have a share of stock, and your position is naturally long, and you're worried that the share prices may fall and you might suffer a loss. And if you want to now hedge this position of yours, if you want to hedge your natural long position, what would you do? You would want to lock in a selling price by conveying your intention to somebody that you intend to sell your asset. So let's just use a different color and make some connections here. So if you want to hedge your natural long position where you have an asset, you would want to convey your intention to somebody that, look, I want to sell off my shares. When it's time for me to sell off my shares, I want to have a lock-in price. So let's agree upon a pre-specified price. So maybe after 90 days, I will be able to sell my shares to you at such and such price, which is locked in. So a naturally long position can be hedged against a going short position, right? On the other hand, let's focus on this sentence here where we are saying that I intend to buy an asset. If you're intending to buy an asset, what are you ideally hoping for? What will happen? You're hoping that the price of that asset will fall in the future and you will be able to make a bargain purchase. But then at the back of your mind, you're also worried about the fact that by the time you're ready to buy the asset, the price of the asset might have gone up. And it would be so nice if you could somehow lock in a buying price for your asset. So if your position uh, 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 if you intend to go long, then your position at the moment is that you don't have that asset. You don't have that asset here, but you're thinking of buying it. So the fact that you don't have an asset means that at the moment you're naturally short, and you intend to buy it by locking in a buying price for yourself. So a naturally short position then can be hedged by going long. So the takeaway from this is that if your current situation is naturally long, you will hedge by going short, which means when you go short, you are going to lock in for yourself a selling price, so that no matter what happens to the price of the asset in the market, you have an assured price at which you can sell your asset. On the other hand, if you have a naturally short position, like here, like here, then you would want to hedge this situation by going long, which means that you want to lock in a buying price, so that by the time you're ready to buy the asset, no matter how high the price might have gone in the market, you will still be able to get the assured price that you had locked in at an earlier date. So that's how you match your positions to create a hedge for yourself. To understand this better, let me throw some questions at you. Let's just write a few things and let's see how you respond. I'm saying that a farmer has just harvested his crop. So situation one, a farmer just harvested a crop, or his crop. So, and if I ask you the question, what is his current situation? What is his current position? What would your answer be? Well, a farmer has an incoming crop, isn't it? So his current situation is natural long. And what is the worry? The farmer wants to sell off his crop, but by the time he takes it to the market, he fears that the price of the product the price of the crop may fall. So he's looking to lock in a selling price. That the risk is that the prices may fall for his product or for his crop. So how can he hedge his natural long position? So that can be hedged by going short. So go short. So this is current situation. So I'm writing C for current, S for situation. And this is the hedge. So if you're naturally long, you go short to create a hedge. And when you go short, what the farmer has done is that he has locked in a selling price for his crop. S for selling, P for price, right? Let's take another example. Where did my pen go? Here it is. So let's take another example. Let's say a jeweler needs gold, to produce rings and bracelets and things of that nature. So a jeweler, let's just write that here. A jeweler needs gold. You know for what? So I'm not going to specify for what he needs gold. So what is his current position? You are needing gold, which means you're short of gold, right? So your current position, current situation or current position is natural short, right? And your worry then is you need gold, but your worry is that by the time you go to the gold market to make a purchase, the price of gold may have gone up, right? And so that increasing price of gold doesn't have an adverse effect on your business, you want to create a hedge. So what does a hedge entail? It means take an offsetting position. So if your current situation or current position is natural short, then the hedge would be to go long, where in going long, you would lock in a buying price for your gold, lock in a buying price. So I'm writing B for buying and P for price here, right? In the interest of time and space. Okay, so I hope you're getting a hang of it now a little bit. Um, Please do excuse my nasal voice. I have chronic sinus issues, so they just keep interfering with whenever I speak for a little while. The nose would get stuffed up and it becomes difficult to pronounce certain words. Let's take another situation. We talked about it earlier as well. You have a share of stock. You purchase some shares in a company, right? So you have a share of stock. And so what's your what's your current situation, current position? So having something means that you are naturally long, because you already have something, you're not short of it. So natural long can be hedged. By the way, why do you need a hedge in this situation? Because you have a share and your worry is that stock prices may fall. And if you need to sell your share at a later date, then you might fetch lesser money than what you spent buying that share. So you need to lock in a selling price for yourself, which can be done by doing what? Go short. So lock in a selling price that way. Let's proceed. Let's talk about a couple of more situations and then we can proceed. Let's say in situation 3, we assume you have a share of stock. In the fourth one, I'm saying you want to buy or purchase. Let's just make up something. Let's say 5 shares. 5 shares of what? Caribbean Airlines, maybe, right? So you want to buy 5 shares of Caribbean Airlines. So since you're conveying an intention that you want to buy, which means that your current situation is that you're short of those 5 shares. You don't have them. So your current position. So let's write current position or current situation is natural short, right? So if you're in this situation, you're worried about the fact that by the time you approach the stock market to buy these shares, the price of Caribbean Airlines shares might have gone up. So you want to lock in a buying price for yourself, isn't it? So the hedge is go long. which will mean that you should lock in a buying price for yourself. All right, so the last one then. Your country produces, well, what do we produce here in Trinidad? You produce oil, right? So let's say you produce 60,000 barrels of oil per day, right? So what is your current position and what is the worry about? You're producing 60,000 barrels of oil per day. So I should have written here barrels. So your current situation is now you have these $60,000, 60,000 barrels of oil sitting with you. So your position is natural, long, and you want to sell off this oil in the oil market. So you want to lock in a selling price for that. So the hedge that you will create is by looking for a short position, which will ensure that you can lock in a selling price. So go short would be the way, and that will lock in a selling price for you, right? Okay, let's proceed and talk formally about the first derivative instrument. So since you've most likely understood what hedging might be, what it can do for you, and how you can accomplish it through offsetting positions, let's look at the first derivative contract scheduled for tonight's discussion or today's discussion. Um, I'm saying tonight because it's 26 minutes past 8 at the moment. Uh, let's talk about, should I change color? Maybe yes. So I'm going with black. So I'm talking about a forward contract. Forward contract. Folks, you understand what a forward contract is by virtue of having read the previous topic on international finance. So let me just remind you that a forward contract is where two parties agree on a price of an asset today itself, but that asset is to be delivered and paid for at some future date. So what are the ingredients then of a forward contract? There is a pre-specified price, right? There is a pre-specified date of delivery, pre-specified delivery date, where both parties need to honor the contract on that date. And number three, and most important, there must be an underlying asset. Something must be there to deliver, and something must be there to accept the delivery of. So an existence of an underlying asset is paramount. Otherwise, what you will establish a price for what, and you will establish a delivery date for what? There has to be something. Right. So a forward contract, then let me repeat, is a contract where two parties would agree on a price that will be applicable to the contract for an asset to be delivered and paid for at some future point in time. Forward contracts, folks, are legally binding on both parties, but as you will realize, forward contracts are mostly private market contracts or private arrangements between parties. Because they are private arrangements, one good thing about forward contracts is that they can be tailor-made to suit the requirements of the contracting parties. But the bad thing about forward contracts is that because these contracts are tailor-made to suit the requirements of the contracting parties, they are not really useful for any other party. So it's difficult to sell off a forward contract to someone else. Let's say you entered into a contract to purchase a car at some pre-specified price. So a new model is coming out, and the car dealer agreed through a forward contract that when the model is released, the dealer is going to deliver the car to you at a certain price, which is agreed upon today itself. Well, and the time frame of the contract, let's say, is 60 days from now. During this time, maybe you changed your mind. You thought that, well, you're not going to go for that model or that make. So you're not interested in the contract, but you know that somebody else, maybe your friend, may be interested in that model. So you can sell off your forward contract to your friend maybe and charge some money for that. So the dealer will make the delivery of the car to your friend then instead of you. Um, but 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 your friend says, okay, but you have gone for this model. I would have wanted to go for a fully loaded one. You went for a basic one, so I'm not interested in this particular contract. So that's what I say, when a contract is designed to suit the requirements of the contracting parties, then it is difficult to sell the contract off to a third party. So in that sense, forward contracts are not very liquid because their saleability is difficult. Their saleability is in question, right? The other problem with a forward contract is that, well, if it's a contract, well, there's going to be a winning party and there's going to be a losing party. So you know that there are two positions. There is a long position and there is a short position, right? So because you wanted to buy the vehicle, you would have taken a long position. So you are long, and the car dealer would have agreed to make the delivery to you. So that is giving something away. So that's a short position. So that's car dealer. So let's assume for a moment, that this pre-specified price was, let's give it a number, let's say $200,000, right? And when this pre-specified delivery date, let's say it was 60 days from now, right? So let's say on the 60th day, the actual price of the vehicle turns out to be $250,000. That's the market price of the vehicle on that day. Let me add a page here and go back a bit so you can see. So on the 60th day, the actual market price, we will call it the spot price on the 60th day. Spot price, horrible C, right? And we will call this, let's give a name to this $200,000 also. Let's call this one, if the forward price. So $200,000 is the forward price. And when you compare it to the spot price, you find that the spot price is greater. So which of these two guys is winning and which one is losing? These are the two guys, you and the car dealer, the one who has gone long and one who has gone short. Well, obviously, this guy, you feel pretty happy about the situation, so happy face, because you are going to get a vehicle which is worth 250,000 at the moment in the market. You are going to get it for $200,000, so you have a happy face. But the car dealer who took a short position and agreed to sell the vehicle to you for $200,000, he will turn up with a sad face, isn't that so? So when that happens, the party at the losing end, in this case the car dealer, has a motivation to default. The dealer can say, no, I can't make it. Motivation to default. So, which means that forward contracts carry a lot of what we say default risk, also known as credit risk, also known as counterparty risk. Your counterparty refuses to perform. Counterparty, counterparty risk. You could call it by the name you like. So this happens with a forward contract. And though forward contracts are legally binding, and you, as a customer now in this case, can decide to take the car dealer to court, you will usually skip the possibility, because going to court, finding a lawyer, that's another hassle, and you have to spend money on the legal proceedings and pay legal fees and so on and so forth, and then wait out till justice is served. So most or many individuals or entities would just let the thing go by without taking a legal recourse. It would be better if there was an inbuilt system of some kind which naturally or on its own automatically reduced this default risk or credit risk without somebody having to take a legal action later on. Towards this end, ladies and gentlemen, you will realize when we talk about it that futures contracts are going to provide an answer. We will talk about futures contracts in a little while, but for now, just keep this information in mind that futures contracts are constructed in a way and they have some inbuilt mechanisms which regulate the trading of futures contracts. So those mechanisms take care of the counterparty risk or credit risk or default risk such that this risk, if not eliminated, is minimized to an acceptable level. With forward contracts, this risk is uh, much larger as compared to the futures contracts. Before we go in for futures contracts, let's uh, talk about the payoffs. A little while ago, we were saying that if the spot price in this case turns out to be higher as compared to the forward price, then the long position wins and the short position would lose by the same amount. That's another good thing about derivative instruments, that payoffs on derivative instruments, payoffs, we'll talk about what we mean by payoffs in a moment. Payoffs on derivative instruments are symmetrical in the sense that if you know what is happening with one party, you automatically know what is happening with the other party. So if one party wins by $50,000, the other party is naturally losing by $50,000. So if there are some formulae to be learned, then if you remember formulae for one side of the equation, that is, let's say if you learn a formula for the long side, then you automatically know what it will be for the short side. It will be the opposite of what it was for the long side. We will see that in a moment. So in this case, what are the payoffs? Payoff simply means the benefit. What do you get out of it? What do you get out of a forward contract? So in this particular example, for now, let's say what was our forward price? Let's call forward price as F, and let us call the spot price as S, right? So for a long position, long payoff, uh, let's redo it here. This would have, the way I've written it, it would have become a short payoff, but I want to write the long payoff first. So payoffs, let's make a separate heading here. Payoffs, and let's just write the two payoffs here. For you who took a long position, what is the payoff? Aren't you winning? You're saving $50,000, something worth $250,000 you can get for $200,000 if your counterparty doesn't run away. That is, so you can calculate it simply by doing this: 250,000 minus 200,000, right? And that's $50,000, 50K. So if you substitute notations for these numbers, what would you realize? That the payoff for a long position in a forward contract is, what is this $250,000? This is the spot price S, and what is this? This is the forward price F. So I shouldn't have wiped this thing out where I was saying that let forward price be equal to F dollars and let the spot price be equal to S dollars. So the payoff for a long position is S minus F, which means automatically the payoff for the short position is, well, how much is the car dealer losing if he performs? Well, he is giving you something for, he is getting from you $200,000 and he is giving you something which is worth $250,000. So in the process, he stands to lose 50K. Now this 200,000 is what? This is F, forward price, and this is what? S. So these are symmetrical but opposite. One is S minus F, so the other is F minus S. So fairly simple to remember the payoffs. Um, Let's discuss these payoffs with a concrete example then. Let us say, let me change color and let us say, let's just create a straight line as a demarcation so that we know that we've started a new example. Now, where did the thing go? Right. So let's assume that you have an accounts payable of let's say £10,000, right? And this is to be settled in a time frame of 30 days. Let's also assume that the current spot rate S is let's just make up something $1.3158 per pound, right? And we also know that a 1 month forward rate. So let's write 1 month forward rate. 1 month forward rate is also known to us. It is 0. Let's say $5319 per pound. Right. So my question to you is, how are you going to hedge the current position? What is your current position, by the way, at the moment? What is your current position? You have to settle an accounts payable in pounds within a period of 30 days. So you will need pounds. So needing something means that you don't have them at the moment. You will require them. Requiring something means that you are currently short of them. So your natural or your current position is natural short, which can be hedged by doing what? Which can be hedged by going long. Going long means what? That you intend to buy pounds. Why do you intend to buy pounds? Because with those pounds, you will settle your bill. Isn't that so? So if someone asks you a question, what is your current position? Your answer would be that your current position is, so let's just write here, current situation or current position is natural short because you're requiring pounds, natural short. And so a hedge, if you want to hedge, that is, if you want to hedge, that can be done by going long, go long in pounds. So your natural short in pounds at the moment, you don't have them. So you can go long in pounds means you can lock in a buying price for your pounds. Lock in a buying price. And what price can you lock in? The forward price. Which is what? $0.5319 per pound. Isn't that so? Let's move ahead and talk about this a little further. So you can hedge your current position if you want to hedge it, that is, by entering into a forward contract to buy pounds at the 1 month forward rate, and that rate is $0.5319 per pound. The question now becomes, since we were talking about payoffs and you are going to take a long position in pounds, what will be the forward contract payoff for you if the spot rate 30 days later, after 30 days, so you are at day 0, you enter into a forward contract at this time, so at the forward rate, which is 0.5319, and then time runs its natural course, you arrive at the 30-day mark here. At that point in time, you observe that the spot rate in the market is, let's say, $0.8130 per pound. Right? So this is also dollars per pound. So my question is, what is your payoff? Since your position in the contract is long, because that's what you decided, go long in pounds. So payoff long position, remember, is equal to S minus F. So that becomes what? What is the spot price at the 30-day mark? It is 0.8130 and minus the forward price, the agreed upon price, the pre-specified price, that is that is 0.5319. So if you carry out this computation, you will realize that this is going to become equal to, let's see, 0.2811, and this is dollars per pound, right? So this is going to be your payoff in the contract on a per pound basis. So for 1 pound, your payoff will be $0.2811. How many pounds are there in question? Remember, you had an accounts payable of 10,000 pounds. So your total payoff then will be equal to, well, you just multiply this by 10,000. So that will give you US dollars, 2,811, right? So that's going to be your benefit that you can derive from this forward contract. Let's look at it in another manner so that this understanding is cemented properly in your mind. I'm asking you this question: what is the hedged cost for you to settle this accounts payable? How much does it cost you in dollars if you hedge your position? So I'm asking, what is the hedged dollar cost rather, to settle the accounts payable? How many dollars you have to spend if you hedge your position? So if you hedge your position, the exchange rate applicable to you is the locked-in exchange rate, isn't it? Which is what? 0.5319. At this rate, you purchase how many pounds? 10,000 pounds. So your hedged cost, you need to spend $5,319 to get the 10,000 pounds, which you will then use to settle your accounts payable. On the other hand, folks, if you had decided to remain unhedged, if you did not use the forward contract, that is, what would have happened? So let's write that: unhedged dollar cost to settle the accounts payable. In that case, the spot rate at the 30-day mark would have been applicable to you. What was that? I can still read it from the previous page here, 0.8130, right? So that is the rate you would have paid then on the 30th day, 0.8130 for 1 pound. And how many pounds did you need? 10,000. So your dollar bill would have been what? $8,130. So if you did not decide to hedge your position, how much would you have paid extra? Or in other words, the question can be, by hedging your position, what is your cost saving? Cost saving through the hedge, right? Forgive my handwriting, but I hope that you are understanding what I'm saying here. Through the hedge, it's horrible. No, I can't just let it go like that. Through the hedge. So through the hedge is what? If you did not hedge your position, you would have had to spend 8,130, but by virtue of hedging through the forward contract, you ended up spending 5,319. So the difference between the two is the cost saving, and if you subtract this, carry out this subtraction, you will find that this is going to be exactly equal to 2,811, which is what we had calculated earlier, the total payoff, the total benefit from the forward contract. So this thing here is the same thing here, right? Okay. But there is another side to this story. Let's just change some numbers. Let's change the color and change the numbers also. So here is your timeline. So you're at day 0 and you have locked in a rate of what was it? Forward rate equals 0.5. How much was it? 5319. and then time runs its natural course. You arrive at the 30th day, and on the 30th day, the spot rate ends up being, let's make up something, 0.473 dollars per pound, right? So now the fact that you have hedged your position means what? So the hedge cost is, well, 0.5319 times 10,000. These many number of dollars you have to pay. So this is 5319. But if you had remained unhedged, what would have been your dollar bill? So you would have been able to purchase the 10,000 pounds at 0.473, isn't that so? And your dollar bill would have been 4,730, which is less than your hedged cost. Isn't that right? So in this case, your total payoff, total total long position forward payoff, long position forward payoff is going to be what? It's going to be 4,730, this amount, minus what you actually ended up paying, 5,319, and that would give you minus, uh, let's see, that will give you 9 and 8 and right, 6 5, so that's 589 dollars negative. So why has this happened? So you will now start believing that hedging must be a pretty bad thing to do. Isn't that so? So that is the catch here, right? Because you lock in your dollar cost by choosing to stay safe. Now, choosing to stay safe has two sides. If the going is bad, then choosing to stay safe will prevent losses for you. But if, like in this case, the one that we wrote with red ink, the exchange rate moved in your favor, you will be prevented from enjoying the upside. So if you want protection against the downside, you will have to sacrifice the enjoyment of the upside as well. That's the bad thing about hedging. So it can save you from losses, but at the same time, it can prevent you. I should say it will. It can prevent you from enjoying the upside, and that is one of the major gripes that shareholders have with managers. So if you are appointed as a finance manager and you love your job very much and you would like to keep your job, you would like to keep your shareholders happy by preventing any losses to the company. And to prevent losses, you decide to go for hedging. So because you know hedging is going to reduce the risk of loss. What you probably don't like is the fact that hedging will also prevent any upside gain, and hedging actually is not about adding value to the firm. Instead, it focuses more on value protection. So, value enhancement is not the objective of hedging. Instead, value protection is the main aim that hedging serves. Um, and shareholders, you work for your shareholders, the owners of your company. So, when are they happy? They are difficult to please in the sense that they don't want something to go wrong, but they also want that the your actions, the manager's actions should add some value to the company as well. And it is a difficult thing to achieve, to try and kill uh, two birds with the same stone. Don't take risk, minimize the risk, and yet provide us with the maximum return possible. Not very easy to do, and that is what creates what we call the agency problem. When shareholders and managers don't see eye to eye, the objective of the manager is to safeguard their jobs. The objective of the shareholders is to maximize the return or the value. So that gives rise to agency problems. So hedging, you should remember, in that sense, is a source. Hedging is a source of agency problem, one of the sources of agency problems, where there is a disagreement between what managers want and what the shareholders want. Right. Let's go ahead and talk a little bit about the problems related to the forward contract. I think I made a mention of some of them earlier. Let's recap problems. So some not so good things about forward contracts. Problems. What are the problems? One, prevents upside gain. We just saw that, right? Then we also saw that there is a significant degree of credit risk or counterparty risk or default risk. Another problem is that it can help you, the forward contract, that is, it can help you in dealing with risks related to prices, but risks related to changes in demand are not that easily hedged. So you can maybe understand this as quantity risk or demand risk. Uh, can't be hedged. Well, you have prepared a certain number of units to sell, but then there is a fall in demand. Now what do you do? There is no derivative instrument that can help you with that. At number 4, we also saw that forward contracts are usually private market arrangements between parties, and therefore they are tailor-made to suit the requirements of those parties. That's what makes them pretty much non-saleable to a third party. So we can say that these contracts then are largely untradable or not liquid. Uh, Not liquid. So they suffer from liquidity risk, that is. If you have a forward contract which you want to sell off to somebody, then you may not find a ready buyer for it. Okay, so let's change the conversation and talk about the next derivative instrument, which is futures contracts. Folks, futures contracts are essentially the same as forward contracts. The internal working is the same, essentially the same as forwards, right? So there is no conceptual difference as such. So like when we say, if I ask you to calculate the payoff for a long position on a futures contract, it will still remain the same, S minus F. And for a short position, it will still remain the same, F minus S. So conceptually, essentially, at the core of it or at the heart of it, express it the way you like it. The futures contracts are pretty much same as the forward contracts, but then there are some telling differences as well. What are the differences? Let's write them in blue ink. Futures contracts are standardized. For example, if you think about silver, one silver contract comes in the denomination of, let's say, 5,000 troy ounces of silver. You may need 2,000 troy ounces of silver, or you may need to sell or buy 6,000 troy ounces of silver. Futures contracts have got nothing to do with that. Their size is standardized. Take them or leave them. Whereas forward contracts, you could tailor make them according to your own requirements. Future contracts, you can't do that. They come in standardized denominations, right? And they trade on commodity exchanges as financial instruments, traded on commodity exchanges. Commodity exchanges as financial instruments, right? So they trade on organized securities exchanges, so to say. Then, now this is important here. Remember how a forward contract would be settled on the day the forward contract is supposed to expire. Both parties to the contract will need to deliver their part of the promise, right? So somebody who had taken a short position would have to make the delivery of the asset, and somebody who had taken the long position would be ready to accept the delivery of that particular product on that day. With futures contract, the settlement of the contract, the settlement. Now remember this carefully. Rarely happens, rarely happens with physical delivery of the underlying asset. Right. So then how does settlement happen then? So let's take this forward. So what happens in place of physical delivery? How is the contract settled? In case of futures contracts, ladies and gentlemen, the contracts are settled on a daily basis. On a daily basis. You will see shortly how. On a daily basis. And this process of settling the contract on a daily basis has some special needs. This daily settlement of the contract can be known as, number one, marking to the market. So we can say that the contracts are being marked to the market. We can also say that the daily settlement means that the contracts are being netted off. Netted off. Don't worry about what these things mean at the moment, just hear them out, right? Or sometimes they also say that these contracts are being squared off. Squared off. So how does this happen? Let's take an example. Let me find the cursor and go ahead. Let's take an example. Let's change color for the example. Let's say, let me write formally here so that you also become aware of the formal way of writing this stuff. So let me write here, you short a 1 month futures contract for $100 today. So when you read this statement, what do you understand? This means, folks, that when you read this part that you short, it means that you have agreed to sell. Right? Sell what? Sell the underlying asset, whatever asset is mentioned in the contract, right? Sell the underlying asset for a price of $100 after 1 month, right? This is what it means. This is what the sentence means. So basically you have taken a short position in this futures contract at the start of the day, right? By the time the working day ends, we find this. So let's change color to make a note of what happens by the end of the day. By the end of the day, the futures price, the terms in the contract of the same futures contract, instead of 100, the terms are saying that if somebody is entering into this futures contract now at this time, at the close of the day, the futures price applicable would be futures price, let's say it falls to $98 for the same product. So before the day ends, this is going to happen. Look at it carefully. Now you took a short position, that is, you agreed to sell something for $100 at the top of the day. Towards the end of the day, the price of that thing has dropped to 98. So do you have a reason to be happy about it, or do you have a reason to be sad about it? Naturally, you have a reason to be happy about it, because though the price has fallen to 98, you have contracted, or you have a specified price to deliver at $100. So something which is worth $98, by the end of the day, you can sell that same thing for $100. Isn't that so? That's what you contracted for. So there's a difference between these two numbers. So at the end of the day, if you have to settle the position, you are winning by $2. So you are going to receive. So let's write, you will receive, you will receive $2 cash profit. It will be credited to your account. So once you have received this cash profit, then the contract doesn't mean anything. It is settled right here, right now. So your current contract, which you entered into at the top of the day, is cancelled because you have cashed out. And if you want to continue to trade tomorrow in the same contract, you will receive, you will receive a new contract priced at $98, right? So that's what's going to happen tomorrow morning. And by the end of the day tomorrow, the price would have changed maybe to something else. And depending upon whether you're losing or gaining, either you will end up paying cash or you will end up earning cash. And then again, the story of that day, of tomorrow, that is, will be settled at the end of tomorrow. And on the third day, you will receive again a fresh contract. So each day's profits and losses are settled on the day itself, and the story is finished there and then. That's how futures trading takes place. But then, in order for you to trade in futures, folks, you just can't go into an organized securities exchange or a commodities exchange just like that. You will need to follow a certain procedure. So if this catches your fancy, if this catches your attention, and you someday think of buying or selling futures contracts, then you will need to follow a process, right? What process would that be? First up, you will need to approach a broker. You cannot trade on the organized securities exchange on your own. You will need a middleman, an agent. And who will that be? You will need to attempt to approach a brokerage house and get a person in charge of your business. So a broker will take care of your business on your behalf. And when you go to a brokerage house, right, you will have to open an account with the brokerage house. This account will be called a margin account. Open a margin account, which is pretty much the same as if you were opening a bank account. The only difference is that whereas in a bank account you can deposit cash and withdraw cash only, in a margin account with a broker, you can deposit and withdraw two things. What are those two things? Well, of course, the first thing is cash, of course, and the second thing is financial instruments or securities, right? So if you, let's say, withdraw some money to buy some futures contracts, so the money will be debited and some futures contracts will be credited to your account, right? So the third thing that you need to take into consideration is that to start a trade, to initiate a trade, the broker is going to insist that you start by depositing some money from your own pocket first, right? Because margin accounts also allow you to borrow. So if you don't have the entire purchase price to pay for something, then you can borrow from the broker also a part of the purchase price. So a margin account allows you that privilege. But even if the broker says that, okay, you can borrow a part of the purchase price, you still will have to come up with some starting amount from your own pocket. You must deposit a minimum balance in your account to start a trade. And that minimum balance is known as the initial margin. Initial margin. You must deposit this set of money in the margin account. So basically, margin is your own deposit, your money, right? So after which you will be allowed to trade in the futures contracts. And as you go on trading, sometimes you will cash out with a profit, sometimes you will cash out with a loss on a daily basis. So the balance in your margin account will keep fluctuating, right? Now, the broker will stipulate that if the balance in your margin account, if the balance in the margin account falls below a certain threshold, you will need to top up your account. You will need to top up the account. You will need to take corrective action, which is to top up the account to bring it up to what is the minimum balance required to top up your account. So the fact that the brokerage house will get in touch with you about this, that look, sir, look, ma'am, the balance in your account has fallen below the certain minimum threshold that you're required to maintain at all times. So the balance has gone below that, and you need to do something about it by topping it up. You need to maybe add more cash to the account, or maybe purchase some securities and add those securities to your account, so that the total monetary value of your account goes above that threshold level. So somebody from the brokerage house will call you maybe, or they may write you an email, right? So they will get in touch with you. That process where somebody from the brokerage house gets in touch with you and tells you that you need to do something about the balance in your margin account, that that communication is known as the margin call, right? And this certain threshold, this minimum balance that you have to maintain in your margin account, yeah, because I just used the word maintain, so let's call it the maintenance margin, right? So if your account balance falls below the maintenance margin level, you will receive a margin call from the broker's place asking you to do something about it. So you can very well visualize the situation now. You have a margin account with a broker. So this reduces your credit risk, because this reduces the credit risk in the entire process, because you cannot initiate a trade unless you deposit some of your own money in the margin account. So some of your own money is at stake. So if you, for some reason, have to default, you cannot do that without losing some of your own money in the account, because if you default, your account will be frozen and you will lose the money and the securities that were there in that account. Also, ladies and gentlemen, you should be aware of a certain financial institution known as a clearinghouse. All payments between the buyers and sellers, for in case of futures contracts, are handled through an intermediary financial institution known as a clearinghouse, and which is generally operated by the exchange itself. So clearinghouse basically guarantees that the terms of the contract from both sides of the transaction will be covered. So even if an individual investor were to default, the clearinghouse will pitch in and have the transaction go through by contributing the money. They also have a contingency fund created for that purpose. First, they are going to ask the individual investor to pay up if they are defaulting. If they are not able to do that, then they are going to ask the concerned broker to take responsibility. And if the broker also is unable to do that, then the clearinghouse from their own emergency funds are going to rectify the situation. So there is a whole institutional framework involved which reduces credit risk on its own in the process, because the clearinghouse is going to guarantee the performance of all contract. Actually, in reality, when you buy or sell a futures contract, you actually never know who your actual counterparty is. With a forward contract, you always knew who you are contracting with. In case of a futures contract, you're simply purchasing a futures contract or selling a futures contract on the exchange. So you don't know, you don't have a face to whom you're selling to or from whom you're buying from, right? So for you, it is the clearing house which always serves as the counterparty. You buy from and sell to the clearing house. So a combination of these two things, the clearing house, number one, and the margin requirements, well, the initial margin and the maintenance margin, so and so on, they act towards reducing the credit risk in a significant manner. In the process itself, it's inbuilt into the system. Instead of taking an action later on, the inbuilt mechanism is such that the process itself will take care of minimizing the credit risk involved. Right. So, folks, let's take an example or two, and then let's close part one of this discussion. I think because it's um, uh, going too long, and maybe it's an information overload for some of you. So we will wind this up by taking up a couple of examples, maybe related to futures contracts. And in part two of the discussion, we will focus separately on interest rate swaps. So let's take an example. Let's call it example one. And let's say, let me write the formal terminology here. Suppose you sell. Actually, I'm borrowing this question from the recommended textbook. So this is, I think, problem number 2 in the recommended textbook. Suppose you sell 5 May 2011 silver futures contracts at the last price of the day, which is this $36.987 per ounce, and the standard contract size is for 5,000 troy ounces. Troy ounces, TROY and OZ for ounce, right? The question is asking, what will your profit or loss be? Basically, they are asking you about the payoff. What will your payoff be? So the question is about payoff. If the spot price turns out to be what they are writing is, if silver prices turned out to be $37.05 per ounce at maturity. That's the question. So what does it mean? This means you have sold 5 contracts, means that you have taken a short position. Selling is a short position, right? So you take a short position by agreeing to sell silver, right? How many contracts have you sold? 5 contracts. What is the size of each contract? 5,000 troy ounces of silver. So how many troy ounces of silver you have agreed to sell? 5 multiplied by 5,000. So 25,000 troy ounces of silver you have agreed to sell at a predetermined price of $36.987 per ounce. On the date of maturity, whenever that is, the actual price of silver in the spot market turns out to be $37.05 per ounce. So does this make you feel happy or does it make you feel sad? So because it's a short position, the payoff is equal to F minus S, right? So what is F? The predetermined price, forward price, 36.987. Minus what is the spot price? 37.05, right? This is your payoff per contract, and as you can see, it's going to be negative, so you're incurring a loss per contract, right? Per contract, and each contract is for how many troy ounces? Is for 5,000 troy ounces. So we are multiplying this by 5,000. So this will give you that you are going to lose. If you carry out this calculation, you will realize that this is going to come out to be negative 315 per contract, right? And because you sold 5 contracts, so your total loss will be 5 multiplied by negative 315, and that will be negative $1,575. So fairly simple, isn't it? You can calculate the payoff very simple, in a very simple manner. Before we wind up, we can take maybe one more problem, and then that will be it. So let's call it example 2, which is about a farmer. So the problem says, this is actually problem number 7 from your recommended textbook. It talks about a date, March 29, 2011. It says that your firm produces breakfast cereal for which you will need, so let me write here, you need 130,000 bushels of corn in December of 2011, right? So what is your current position? Because you need something, you are natural short, right? So let me get rid of this email thing. So your current position is natural short. So if you want to create a hedge, you will do so by going long, which is that you will need to lock in a buying price, So what position will you take in this futures contract? You will take a long position, in futures contracts. Right, so we have determined this. So let's look at the terms and conditions of these futures contracts. The problem further tells us that the settling price for a December futures contract is, settling price means we are going to assume it to be our forward price. So for a contract which expires in December, the settle price or the forward price is 6.0025 per corn bushel, right? And the standard contract size is, well, if you buy one contract, you will be obligated to purchase 5,000 bushels. Right. So the question is, how could you use corn futures to hedge your exposure? We have answered that, and the answer is we could hedge our position by using corn futures by taking a long position in those contracts. Then the next question is, if the corn price ends up being $5.83 per bushel in December, what are the consequences? So which means that they are giving us a spot price that when the contract matures in December, at that time, the price of one bushel of corn in the open market, the spot price that is $5.83. So what are the consequences for you if you had taken a long position in the contract, right? So uh, let's create some space and do this. So you're bothered about a rise in corn prices. So and each contract size is 5,000 bushels. So number of contracts you will need to purchase is, well, how many bushels did you need? Let's go back and see. 130,000 bushels is what you need actually, and each contract gives you 5,000 bushels. So the number of contracts you will need to buy will be 130,000 divided by 5,000. That's going to give you 26 contracts. So you will take a long position in 26 contracts. And if you do that, you lock in a buying price of this 6.0025 per bushel. This is the locked in price, which means that your total buying price would be purchase price, total purchase price for 130,000 bushels is going to be equal to, well, 130,000 multiplied by 6.0025. If you work this out, this will be equal to 780,325. So this is your fixed cost because you have locked it in. But when the contract matures, the spot price ended up being $5.83, right? So if you had not hedged your position, what would have been your cost? Unhedged cost would be what? Unhedged cost would have been that you would have been able to purchase your 130,000 bushels at a price of 5.83 per bushel, and that would have worked out to be equal to 757,900, right? Which means that your payoff is, well, F minus S. So if you went with the forward price, this is what you would have ended up paying on a total basis, 780,325. And if you remain unhedged, then this is what you would have to pay, 757. Sorry, we are going long, so it should be S minus F. Sorry, S minus F. So this is the payoff for a long position. So let's rewrite this. So the spot price, if you remain unhedged, this at spot you would have paid this much, 757,900, and if you hedged, then you would have paid 780,325. 325. So that means that by hedging your position, you would end up paying $22,425 extra, and that's your loss. That's your negative payoff from this forward contract. So it would have been better in this scenario for you to remain unhedged, but then nobody knows what the future holds. If you remain unhedged, and if the spot price ended up being $7 per bushel, then you would have lost, and then you would have been in the firing line as a manager because your shareholders would tell you that, look, you couldn't even foresee such a basic thing, and you couldn't protect us from an increase in prices, so you're fired. But now, on the other hand, you went ahead because of that fear and locked in a buying price of 6.0025. But when the contract matured in December, it turned out that the actual spot price was $5.83, and you will still be in the firing line because, again, your shareholders will tell you, look, as a manager, what are you doing? You can't even foresee what the price is likely to be at the end of the year. I mean, you have been in this job for a while and you don't feel the pulse of the market, and you're this and you're that. So there's no easy way out. In this case, anyway, you are losing because while the price of the corn your firm needs has become $22,425 less expensive, your loss from the futures position would have netted out this lower cost, right? Because you would pay anyway the contracted price of 783.25. Right. Ladies and gentlemen, before we close, I'm asking you that from your reading materials, you should read about what are the main differences between forward and futures contracts. If you have followed this discussion up until this point, you would already have that in your mind how forward contracts and futures contracts are different. So when you go back to your reading materials, just look at those differences so that they are reinforced in your system. And when we come back for the second part of this discussion, we will, as I said earlier, focus on the interest rate swaps, and that would complete the discussion on this topic, which is risk management in case of the companies. So you could call it the corporate risk management or enterprise risk management. For now, ladies and gentlemen, it's goodbye from my side and see you in part two of this discussion. Bye bye and take care.